So let's go to the state of the markets now, which have fallen in recent weeks, partly as a result of interest rate rises, but also then to celebrate the career of a funds management Hall of Famer and also a regular here on Business Weekend, Anton Tagliaferro, the founder of Investors Mutual, who is bowing out from the company after 25 years. I think it's March sometime, isn't it, Anton?
March to June, somewhere there. Yeah.
That'll be good. Now, okay, so I just want to bring you in on this because the state of the markets now, and even the way in which the funds management industry is composed, there's more private equity. I read during this week that Australian Super, one of our biggest investors, is thinking about bringing all of its investment in-house. Does this change the way in which investment managers operate?
Look, Ross, it's always been a very competitive industry. I mean, I've been in it for a long time. If I go back 25, 30 years, 35 years, you know, you had the old mutual companies, AMP, National Mutual, Colonial, Zurich, whatever, they've all sort of disappeared. And then about 10, 15 years later, we had all those other managers like BT and Rothschilds and Colonial and Merrill Lynch. They've all disappeared as well. So, look, it's always in a state of flux. I guess the big super funds now are getting so big. They're almost taking a bit the place of the old mutual fund, the old mutual companies, you know. So, look, it makes sense. Look, is it a tough industry? Yeah, it is a tough industry. I mean, more and more people are going direct. ETFs are obviously having quite a bearing.
I was going to ask you about that. So ETFs, index trackers, in many ways, they're the easy option for investors because they give a promised return. Now, regardless of whether you like the return or not, it's a promised return. It will match the index.
Yes.
Now, the fact of the matter is, as a stock picker, you sometimes take longer to outperform that index, but more expensive as well.
Look, Ross, in some ways it's become easier, in some ways it's become more difficult. It's become easier sometimes because there's so much computerized trading now that stocks can move, you know, huge percentages in a week or two. If
but the index fund will pick that up. That's hard.
Well, they'll probably sell. So as a fundamental investor, sometimes it provides opportunities, right? So there's another side of it. But again, sometimes you have to buy and you know, a downgrade will hurt and you have to sit there and wait till the company turns around, which a lot of these guys, you know, they work on algorithms and upgrades and whatever, and they, you know, when the upgrade comes through, they all charge in. So you have to be you have to be aware that the market's changed from that point of view, that short-term news can often, you know, really impact on companies' value, you know, share prices. Yeah, okay. A lot more than, say, 20 years ago.
So then go to the companies themselves because they cry for patient capital. But you've got private equity coming and taking so many businesses off the market. And I mean, just in the past week or so, we've seen Origin Energy, Brookfield has come in there. You've got InvoCare. You've obviously got a takeover that's emerged this week, TPG. Crown last year, big deal. You're a big shareholder in Crown. So these are companies, publicly traded companies coming off the market for investors who are seen to be more patient.
Well, I suppose, I mean, I think the sad thing about the Australian market is the number of companies has declined. I mean, you think about, you know, we used to have 2 brewers listed. There's no brewers, you know, Foster's and Lions both got taken over. We used to have food companies, Goodman Fielder, Snack Foods, Australia, whatever. Arnott's, they've all gone, right? So, but again, private equity does depend very much on where interest rates are, you know, because they do highly gear companies, and they're not perpetual owners often of businesses. So
because they need an exit, don't they?
Exactly. So look, and
Virgin's a good example of that.
Yeah, look. So some of these businesses being swallowed up, they'll be restructured, whatever they do, and of course they need an exit, right? So that's on the upside. I think so. That's the way it is, right? So, and I think, to be honest, given where interest rates are going now, that's putting a lot of pressure on private equity funds.
Yes.
Because the cost of debt, you know, some of these deals are very, very highly geared.
Yes.
You know, you wonder some of those takeovers, even Crown, you know, given where interest rates are today. I think Crown's fine because it owns the property, but do you know what I mean? It's harder today to fund something with high debt.
Because if you're having to borrow at 8-9% at the moment, which you probably are for some of those sort of risk-style businesses, that makes the actual case of what return you're going to receive for your investors more difficult.
Plus, Ross, you get the added complication that obviously at times of economic decline, sometimes the revenues drop as well. And this is the problems the entrepreneurs had in the 90s, where they borrowed heavily. And of course, they were faced not only with record high interest rates of 21%, but also a lot of businesses, their revenue declined. So, you know, Bond Corporation took over Channel 9 and was a big price anyway. Yeah. But of course, a year or two later, you know, rates doubled or trebled, and obviously advertising revenues fell as the Australian economy slowed.
So then take me to the state of corporate Australia right now. We've just been through a profit reporting season. And look, to be honest, the results were mixed. The outlooks are mixed. They're worried about what happens with high interest rates when family savings run out, when consumption ends, as though there's some sort of a barrier or a brick wall ahead before the economy can move to the other side. What's your own sense?
Well, look, again, most of the results, again, you've got to remember you're cycling the COVID period as well from the previous December, so you're beginning to get a sort of normalisation of demand, whatever that is, in the travel industry, in the retail industry, etc. On top of that, now you've got the added complication of interest. So most results, if you look at the retailers, you know, JB Hi-Fi, Nick Scott, they had very good results. Myer, you know, very good results. So people are still spending. The truth is, you know, the impact of interest rates, there's always a lag. And I guess this is the issue that central banks have is, you know, they're trying to engineer a soft landing, but it's a very delicate situation because if you go too hard, then the economy slumps. You know, if you leave it too easy, then people keep spending. Yeah. So, and that's where we are at the moment. So nobody's quite sure how high rates have to go. Clearly, there's an issue in the US and in Australia. Employment is still strong.
Well, that's the thing. I mean, Jerry Harvey says there's no downturn. I see incredible demand and people have got jobs. And while people have got jobs, they're going to keep on coming and buying things.
Yeah, so as I said, it takes time for the impact of high interest rates to hit various industries. So clearly, we're seeing a slowdown in the building industry, you know, the construction industry. At the moment, their order books are full, CSR, whatever. But once those apartment blocks, you know, finish, it's getting very hard now to get a new loan for a developer. So there's going to be a bigger shortage in Sydney, would you believe, than not.
Anton Tagliaferro, it is always great to get your input on this program, and many thanks for your time.
Great to see you. Thanks, Ross.